So the 2008 market crash was mostly due to adjustable rate mortgages, or A.R.M loans. So there's a lot of reasonable fear when it comes to those types of loans. In this video, we're going to break down what the differences are between fixed and adjustable rate mortgages, and if it ever makes sense to have one over the other, or when. So to kick off, I personally have two interest-only A.R.M loans. Why would I want that? And I also have two fixed-rate loans. Why would I want that? Let's take a second to reflect why we're even buying real estate, because the reason why you're buying is going to influence why you would even want a certain type of loan. One, we want to make payments on something we own. Two, we want to build our wealth portfolio. Three, we want to invest our money outside of just a bank. Four, we want tax write-offs where we could write off the interest or other repairs to the home. And lastly, and probably most importantly, we want the feeling of calling the place our own and everything that comes with it. So first, let me remind you there are four ways of making money in real estate, depending if you're an investor or if this is just your regular home. Number one is appreciation. That's when the value of your home goes up over time. Number two is principal pay down. These are the payments that either you or your renter are paying towards your principal every month. Three is depreciation. This is what you can write off over the lifetime of your actual property. You can depreciate the property and the items inside of it because you're going to have to replace them over time. And the last one is very unique to both homeowners and investors depending on your strategy, is cash flow. Homeowners can build an ADU, they can rent a room, they can rent out the garage, can do a garage conversion, they can build up. Investors are obviously investing primarily for cash flow and appreciation, depending on where you are. So let's come back around and see how both of these types of loans, either a fixed rate or an A.R.M loan, can actually help us make money if I'm a homeowner or investor and my primary goal is to have the lowest possible payment so that I can stay afloat in the high interest rate markets and cover my mortgage while also making a little bit more money in my pocket, or keeping a little more money in my pocket. Then it's more attractive to go with an interest-only loan. That's because not every interest-only loan starts with an adjustable rate mortgage. For example, there are 3-1 A.R.Ms, 5-1 A.R.Ms, 7-1 A.R.Ms. What that means is that the interest rate is fixed for 3 years, 5 years, or 7 years. And after that segment of year, so let's say after the 5th year, if it's a 5-1 A.R.M, the interest rate can go up by 1% that next year, and it can adjust once per year. So if I think that interest rates are going to be lower in 5 years than they are right now, which right now, by the way, I was quoted at 8% interest rate on an investment loan, then I am going to go for the most amount of cash flow for the next 5 years. And in that 5th year, I can go ahead and sell that property, or I can refinance into a lower interest rate. All while in those 5 years, I've cash flowed, my house is appreciated, and I've leveraged the depreciation. The only way I'm not making money in this interest only type of loan is through the principal pay down. But am I okay with that for these 5 years while I cash flow? Yes. So that's one example of when you might want an A.R.M loan, especially if you're in a high interest rate market. A fixed loan is more common sense. If the interest rates are low, let's say 3%, 4%, it makes more sense to just lock in that rate for a fixed period of 15 to 30 years, and maybe you do refinance far into the future to cash out some money if you don't want to sell the house completely. In most cases, the fixed rate makes sense, but in today's market in 2023, the interest only options are attractive so that you can qualify for the lower payments, or you can cash flow more money today so that you can refinance later when the interest rates drop again. And you are taking a risk when you get into a 3-1 A.R.M, a 5-1 A.R.M, or a 7-1 A.R.M because you're not sure when the interest rates are going to drop. So the things to watch out for with the A.R.M loans are the prepayment penalty. For example, if you get into a 3-1 A.R.M loan and interest rates drop in this next year and you want to refinance into a lower interest rate, you're going to pay a prepayment penalty, which means that you have to pay off that loan and you have to pay the lender for any interest they didn't accrue on you for the future. So it's sort of an educated guess if you think that interest rates are going to stay high for the next few years. This is why I chose a 5-1 A.R.M loan, because I do think interest rates are going to stay high for the next few years. But I know my prepayment penalty might end at year 3, so I could refinance at the end of year 3, or maybe beginning of year 4, or definitely year 5. So before my actual adjustable rate mortgage hits, I'm able to refinance into a lower interest interest rate. And like I said, if we're getting into interest rates that are 6, 7, 8% or even more, then we're definitely going to want to refinance in that 4th or 5th year. The other thing to keep in mind is with a fixed rate loan, the principal payments are pretty low in the first 5 years. You're mostly making interest payments already. Overall, when interest rates were low, it didn't really make sense to get into an interest only loan or an A.R.M loan. But now that interest rates are so high, it might make sense to get into that type of loan just for a few years so that you can cash flow more money, or you can keep more money in your pocket instead of dishing it out every single month. And there are different types of A.R.M loans out there. So whether you're an investor, you can also get an A.R.M loan that's called a DSCR, which is a debt service coverage ratio. If you want to talk more specifically about your situation and if an A.R.M loan is right for you, or a DSCR loan or an investor loan, or maybe you're older than 62 years old and you're looking for a reverse mortgage, whether you want to do fixed or an A.R.M loan on the reverse mortgage, reach out to me via email. I'll leave that in the description, or you can also DM me on Instagram if you're on there. And if this video was helpful in any way, consider liking and subscribing, and that way more people can get the same type of value you just did. So I appreciate you for tuning in, and good luck.